Oh, hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. I'm going to get you folks what you need to know before you roll, and that's going to be talking about the economic data, see how that impacts the overall markets with a little market analysis, and then top it off with maybe a little geopolitical fodder to round that all off. All right, so without further ado, let's get on with that economic data. We didn't get really anything yesterday or Friday. Friday we did get the ISM. Which came in line with expectations, maybe a slight tick lower there, but still above that 50 number that we're looking for. So showing expansion in the economy. Now, I know a lot of folks are calling for a recession right now because we've had some negative GDP numbers. I'm not calling a recession at this point. We haven't really seen these manufacturing numbers, these real producer numbers come below 50 or show contraction at this point. So I'm not calling for a recession at this point. It's looking pretty darn close. As you can see, we also got Biden speaking over the weekend, asking the gas stations to lower their prices at the pump, folks. Okay, that's how we're going to tackle this. Right. Really, this comes down to a supply and demand issue. We aren't seeing the supply increases, so the demand is remaining relatively constant. That's driving prices higher. It's not going to be something where we can go at the gas pump guys and say you need to lower your prices. They're working on their margin. Yeah, we can all argue, split hairs on how much profit they should be able to take or what they are taking versus, what we could afford necessarily. But one of the things is the guys at the pump really aren't the ones that are driving these prices to $5 a barrel. It is the administration not allowing the supply to come out. And that is what's driving prices, folks. So with that said, a lot of geo fodder over the weekend, kind of, trying to give Americans a little bit of solace in where we are, but it's really just kind of falling on deaf ears as far as I'm concerned. But that was about the biggest economic or geopolitical fodder we got driving the markets today. And I don't think that it left a lot of people with confidence there. We did get some PMI numbers, Purchase Managers Index. Remember, we got the final reads on Friday, but all of those, again, still above 50, showing expansion in the economy. We haven't seen these start really showing contraction, so that's a good thing, despite the fact that we're all feeling the pain of the economy. The economy is still moving along here and is expanding, despite the fact that we aren't probably expanding as fast or as much of a clip as we would like to see there. All right, markets, let's get on with them. We've got crude oil here, just a little bit off on the day, but we are looking at this market being a little overextended and wanting to come back down into this value area that I've been talking about this week. Need to break this 100 handle relatively soon in order to save the backs of the American people. From London, Sirloin. Sirloin from London. Love it. So looking at this to try and save our economy, this is really what we need to see as these prices coming off here globally. As we're seeing the tensions still escalate over in Russia, at least here in the United States. If we open up the pumps, for the most part, or the fracking, we could see supply hit the system and globally see these prices start to come down. I'm not saying that the United States can, save the world on prices at the pump, but we can show that we are ramping up production. That is the key to all of this, is showing that we are increasing supply. Right now, it looks like we are decreasing supply and not ever going to go back to increasing supply. So that's the fear right now in crude oil, is that we'll never get the supply back. Bonds continue to move higher here. Now, we've talked about this. As bonds move higher, that means interest rates are going lower, long-term interest rates. We've been seeing economic data points since the 70s that aren't looking so good for inflation and expansion in the economy. So we would like to see, again, bonds move higher. I would, yeah, for sure. If we continue to see bonds move higher, is this a bit of a signal here? Well, we've been seeing the Fed fund futures. Well, they've been pricing in higher interest rates, right? Well, if you're looking at the longer duration there, we're actually seeing a couple of places there, a couple of years down the road, where we are actually not even quite quite a year down the road, where it almost looks like basically in 2023, we could start seeing a Fed that starts lowering interest rates, meaning they've overextended themselves too much by raising interest rates too quickly right now. So markets saying, yeah, we see that they're going to raise interest rates right now, but we are also pricing in a reversal here relatively shortly there. So while bonds starting to move higher here is also following the tail end of that Fed fund curve, where the Fed funds are showing near-term higher interest rates, but longer term that the interest rates have a probability, a pretty decent probability of moving lower towards the end of 2023. Bitcoin, I'm not even sure what to talk about here. Now that it's broken below that 20,000 pretty solidly. Any break below this 18,000, I think it was 331 or whatever, 250 is really would be my number. 18,250 would be something I'd be concerned about. We can see 18,500's held a couple of times. That's been the low. We've got the Fibonacci lining up just below that. But folks, it needs to hold this, or I think that they're throwing the baby out with the bathwater, and we're going to watch this market really have some capitulation moments there. While crude oil is below the 50-day simple moving average, like I said, it did get a little bit of a bounce. I don't know why I'm on crude oil, but back to crude oil there. But we want to see this back down in the mid 70s probably would be a really nice place for that. Gold looking like we were going to find a bottom here at the point of control. I've been expecting this market to move to the upside. I've been planning for it, waiting for an opportunity, but we just haven't gotten that, which is very surprising to me. And I've talked about this time and time again. What are people doing? Generally speaking, levers and pulleys in the markets would tell us that when the economy is bad or the stock market equities are pulling back, the flight to safety or flight to quality is into things like bonds. Well, we're seeing the bonds make that move. I think that's more of a predictive nature on interest rates. And gold would move higher, but we're not getting this gold move to the upside. And I think that it is really because folks are right now not really wanting to see a massive long duration sell-off here in the equities. They're not very concerned that this is going to last very long, which is why I believe people are actually just sitting in cash. Speaking of sitting in cash, if you're sitting in cash, yes, you are losing money to inflation, but broader speaking, we are gaining in value in regards to the euro, let's say. As a matter of fact, is the key point I'm thinking of is the euro versus the dollar strength versus the euro. It might become parity here pretty soon where it's 1-to-1. Now, we haven't seen that in 20 years. 20 years ago, the dollar was stronger than the euro. And, that's why a lot of Americans were loving going overseas, is because our dollar is stronger over there. It feels like you don't have that inflation. So we could see a lot of that happening again, as folks here are saying, hey, prices are really expensive, but if I go over to Europe, it seems pretty cheap anymore. All right. So we could see that kind of vacation happening, but strength in the dollar, almost back to parity with the euro. It's going to be probably a pretty big moment in the markets to see that happen, especially if the dollar becomes stronger and we get back to that again. With that said, there is strength in the dollar, but we aren't really seeing anything here in gold making a move to the upside as it would be a store of value. Now, we could say that weakening gold futures, weakening gold price is due, in fact, to the strength of the dollar. But I think that the dollar strength, or the strengthening of the dollar that's happening right now, is really not, it can't hold a candle to the sell-off in gold. Most likely what we would normally see is folks buying gold futures or buying gold to wait to reallocate. But because they're waiting on that gold, they're not buying that gold. I think it's a whole timing issue where they're thinking, I don't want to allocate this money because it's too hard, especially when you're thinking of a behemoth investment vehicle. It's too hard to roll out of one product into another very quickly. All right. They aren't going to be able to move as fast as you and I can move. So they've got to move a lot of money. So I think that a lot of them are sitting on cash right now and not allocating any because they can't allocate rolling out of one thing into another as quickly as just having that cash on the sidelines there. And we've been talking about the markets here. I've been calling these almost to the hour, folks, on the sell-off and rallies. We got the rally on Friday, and I said, hey, don't really buy into that rally. It is going to be the retail investors thinking that they are bargain shopping when the institutional investor has gone on vacation. And really, that's kind of what we were seeing here in the markets with the late day sell-off or the early morning sell-off where the institutional big money was selling into that rally or into the open. Then late in the afternoon, a couple hours later, we got the snapback rally almost to the highs, making it look pretty strong. I said, I think that is a fake out. I would be weary of that. The strength was on vacation. The money guys were gone. So we did get that snapback to the upside in equities, but I think we're going to see some weakness here today as we get those institutional investors coming back, realizing, hey, nothing's changed over the weekend. Selling pressure should commence. We can see what we were talking about. It was a little bit clearer on Friday where we got the early morning rally in the equities, made the highs of the session for the most part. And then market just selling off throughout the day, the early morning session. Then what happened when those guys took off? We got that relief rally. Over after the close, market really snapped to the upside. I don't know why that would be. There wasn't anything fantastic coming out after Friday's close. And now weakness throughout this morning session. Its overnight inventory is very short and probably no attempt to snap out of this. Could get a half back would be my guess, meaning a rally halfway back to this Fibonacci here anyway, or touch this Fibonacci. But I think the weakness is here. There's nothing really out this week that's going to probably have enough strength kicking the pants to turn this market around from a bearish trend, especially if we have, our administration asking the pump to lower prices. That's not going to happen, folks. They are basing their prices off of gas prices, and they have to get their profit, right? They're buying it from somebody else. This is all the way down to the guys that are taking it out of the ground, okay? And even the wildcatters, to be quite honest, the wildcatters are the ones that have the highest risk in the game, and those guys aren't probably willing to take too much risk right now with this current administration. Therefore, folks that are investing are also seeing that there is no future expectation of more supply. So that's really going to cause those crude oil prices to stay elevated. We need to see a very big shift in that dynamic in order to get these prices down. Hell, I was even listening to one news reporter, and maybe going over a little overboard as most news reporters do, but saying folks are skipping meals because of these higher prices at the pump. They have to pay $130. They have $100 to spend in their budget. What do? I mean, really, when you got $100 in your budget and you got to fill up your tank and you got to feed your family, what do? Right? All right. Anyway, that's all I got for you guys. I would be watching this to the downside. Again, bonds are starting to rally. How much further can they go in the near term? Not a whole lot of room. Longer term tail risk, it's saying that, hey, they're going to have to start lowering interest rates after they've overdone it to the upside, which is typical of an FOMC, to be quite honest. As much as everybody says we don't have a whole lot of confidence right now in the FOMC, well, to be honest, as a trader, most folks have never really been that confident in the FOMC. As a matter of fact, there used to be a statistic saying that I think it was basically 100% of the time they overdo their rate moves and have to retract a little bit in order to rebalance it. It's never been a time where they've moved interest rates to a point and they were dead on right. They've always had to either increase or decrease and fine tune that rate. So That said, hopefully that gives you a little bit more confidence in your trading. The bottom line is nobody really knows. So trade as you will. I would say risk is to the downside in equities. Bonds, risk is to the upside, but look for opportunities to sell covered calls in a bond portfolio, lower that overall cost basis, because interest rates are going to go up and we might never see zero interest rates again. So take advantage of lowering overall cost basis there. Upside risk, I would say I would be looking for the oil companies. That's where you're going to see your upside because they can grab that margin. Just because the administration is asking them to lower the prices at the pump isn't going to do anything because it costs too much to take it out of the ground at this point. All right. So that's all I got for you guys. Hope you had a great weekend. Everybody came back with their fingers and are ready to fire away. If you can't take, that was a shorty. If you can't take that, take it easy. Bye for now.